If you've been keeping your savings in a regular bank account, thinking it's the safe choice, I need to show you something that might change your mind. That $50,000 you're protecting today, in 30 years, it will only have the buying power of about $27,000. And I'm going to show you why that happens and what you can do about it. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. Let's start with something you probably noticed yourself. That coffee you bought $1.50 a decade ago, it's $2.75 now. Your grocery bill keeps climbing. That's inflation, and it's not going away. The Bank of Canada deliberately targets 2% annual inflation. Now, 2% might sound small, but here's what it actually means for your money. If you need $60,000 per year to live comfortably today, in 20 years, you need about $90,000 to maintain the same lifestyle, same groceries, same restaurants, same everything, but nearly 50% more money. The only reliable defense against inflation is investing in assets that grow in value over time. Keeping significant money in cash, that's actually a losing strategy for long-term wealth building. Here's what this looks like in real life. Meet Sarah and Emily. They're sisters, both 30 years old, both earning $70,000 a year, both planning to retire at 65. Sarah invests 10% of her salary, that's $7,000 a year, and earns an average 6% return after inflation. By age 65, she has approximately $830,000 in today's dollars. Emily is nervous about stock market volatility, so she keeps her 10% savings in high interest savings accounts, earning about 2%, basically just matching inflation. By 65, she has only $350,000. That's less than half of what Sarah has accumulated. For Emily to reach Sarah's retirement outcome while staying in savings accounts, she would need to save 24% of her income instead of 10%. That's an extra $9,800 every single year. Money she can't use for vacations, home improvements, or living her life. This is why investment returns matter so much. Higher returns don't just mean more money at the end. They mean more freedom and flexibility in your life right now. But if investing is so important, what exactly should you invest in? For most Canadians building long-term wealth, it comes down to two primary investment types: stocks and bonds. Let's start with stocks. When you buy shares in a company, you become a part owner of that business. Your shares represent a claim on the company's future earnings. If the business grows and becomes profitable, your ownership stake typically becomes more valuable. This is why stocks or equities can deliver substantial long-term returns. Successful companies grow, innovate, enter new markets, and increase their profits year after year. And as an owner, you benefit from that growth without doing any of the actual work. Looking at data spanning over a century, equity markets have delivered average returns in the 6 to 9% range after inflation. But, and this is crucial, these averages hide enormous variation. During the 2008 financial crisis, Canadian stocks dropped about 35%. During COVID in March 2020, they fell about 30% in just weeks. These aren't hypothetical scenarios. They're real experiences that tested investors' resolve. But in both cases, markets recovered and went on to reach new highs. Investors who stayed the course captured those gains. Those who panicked and sold locked in their losses and often missed the recovery entirely. Another thing that matters so much is geographical diversification. In 1899, the United Kingdom was the world's dominant economic power, representing about 25% of the global market value. British investors who concentrated their portfolios domestically seemed prudent. After all, the British Empire was vast and powerful. Fast forward to today, the UK represents less than 4% of global market capitalization. Two world wars, the loss of colonial territories, and the rise of American and Asian economic power fundamentally reshaped the global landscape. Similar stories could be told about Germany, France, or Russia. The lesson? No country's economic dominance is guaranteed to persist. Geographic diversification isn't optional, it's essential. Research analyzing thousands of US stocks from 1926 to 2019 found that the majority of individual stocks underperformed treasury bills over their lifetimes. Only about 4% of stocks accounted for all the net wealth creation in the stock market. Let that sink in. 4%. This means picking individual stocks is essentially trying to identify the small minority of companies that will be big winners. Even professional analysts struggle with this. Missing just a few of those winning stocks can dramatically hurt your portfolio's performance. The solution? Hold thousands of stocks rather than trying to pick winners. This way, you capture the returns of those exceptional performance while limiting the damage from the inevitable losers. Now let's talk about fixed income, bonds. These work completely differently from stocks. Instead of buying ownership, you're making a loan. You lend money to a government or a corporation, and in return, they promise to pay you regular interest and return your principal at a specified date. If you lend the government $10,000 by purchasing a 5-year bond, paying 4% annually, you'll receive $400 each year and get your $10,000 back at the end of 5 years, regardless of how well the economy performs during that time. This structure makes bonds more predictable but less lucrative than equities. Bonds serve several important purposes in your portfolio. First, stability. Bond prices fluctuate much less dramatically than stock prices, providing stability during market storms. Second, predictable income. Regular interest payments can help fund spending needs in retirement. Third, there is psychological buffer. When stocks crash, bonds often hold steady or even increase in value, making it easier to stay invested. And fourth, rebalancing opportunity. You can sell bonds to buy stocks when prices are low. But bonds come with their own risks. Rising interest rates cause bond prices to fall. Inflation can erode the purchasing power of both the interest payments and the principal. And bond returns are generally lower than stock returns over long periods. Your equity to fixed income ratio is one of the most important investment decisions you make. More equities mean higher expected returns with greater volatility. More bonds mean smoother returns, but slower wealth accumulation. There is no single correct answer. A 30-year-old with steady employment might comfortably hold 90% equities because she has decades to ride out market turbulence. A 70-year-old retiree might prefer 50% equities and 50% bonds to reduce short-term volatility. The key is choosing an allocation you can stick with during inevitable downturns. A portfolio that's theoretically optimal but causes you to panic and sell at the worst time is inferior to a more conservative portfolio that lets you sleep at night and stay invested. So we know what to invest in, but how do we actually do it? Walk into any bank in Canada and you'll likely be offered actively managed mutual funds. Professional fund managers who study companies, analyze economic trends, and try to identify undervalued securities that will outperform the market. This sounds compelling, right? Why wouldn't you want experts working to beat the market on your behalf? The problem is, it rarely works out as promised. Data from S&P Dow Jones indices show that over 10 years, roughly 90% of actively managed Canadian equity funds underperform their benchmarks. 90%. The percentage is similar for US and international equity funds. And funds that outperform in one period rarely continue outperforming in subsequent periods. So why does active management struggle so consistently? Modern financial markets are remarkably efficient. When companies release earnings reports or announce new products, stock prices adjust within seconds or minutes. Millions of investors and sophisticated algorithms constantly buy and sell based on new information. For an active manager to outperform, they need to consistently know something the market doesn't, or interpret public information better than the collective wisdom of all other market participants. This is extraordinarily difficult to do repeatedly. And there's another problem: cost. Fund managers, analysts, traders, and administrative staff all need to be paid. This costs typically add 1 to 2% annually in fees. Starting each year 1 to 2% behind the benchmark, that's a significant handicap to overcome. This brings us to index funds. Instead of trying to beat the market, they aim to match it. An index fund tracking the S&P TSX Composite Index simply owns all the stock in that index in proportion to their market values. This approach offers several advantages: lower costs, fees as low as 0.05 to 0.25% annually; broad diversification, you automatically own hundreds or thousands of securities; transparency, you know exactly what you own; tax efficiency, less trading means fewer taxable gains; simplicity, no need to research funds or worry about manager changes. By accepting market returns minus a tiny fee, you essentially guarantee yourself above average performance relative to the majority of active investors. Let me show you what fees really cost over time. Two investors, both starting with $50,000 and contributing $500 monthly for 30 years. Investor A uses index funds with a 0.2% fee. She earns 6.8% net annually. Investor B uses actively managed funds with a 2% fee. She earns 5% net annually. Same gross returns, but failing to add value through active management. After 30 years, Investor A has approximately $820,000. Investor B has only $580,000. That seemingly small 1.8% fee difference cost Investor B $240,000, nearly 30% less wealth. And remember, this example assumes both earn the same gross returns. In reality, most active funds underperform even before fees. The gap would likely be even larger. Once you've decided to invest in index funds, you face another question: how much should you allocate to Canada versus the United States versus Europe versus emerging markets? The simplest approach is market capitalization weighting, allocating based on the relative size of each country's stock market. If the US represents 60% of global market value, you'd allocate 60% there. If Japan represents 6%, you'd allocate 6% there. This approach has several advantages. Market prices already incorporate the collective wisdom of all investors. More successful and less risky companies naturally become larger, earning greater weight in your portfolio. Now, pure market cap weighting would give Canadian investors only about 3% exposure to Canadian equities. But most Canadian investors benefit from holding somewhat more than this. Here's why a home country tilt makes sense. Currency matching. Your expenses are in Canadian dollars, so holding Canadian assets reduces currency risk. Tax efficiency. Canadian dividends receive favorable tax treatment through the dividend tax credit. Lower foreign withholding taxes. Foreign dividends can face withholding taxes. Familiarity. You understand the Canadian economy and business environment. Many Canadian asset allocation products target 25 to 30% Canadian equity exposure. This provides meaningful home country benefits while maintaining substantial international diversification. Now, markets don't always move in lockstep. Some years, Canadian stocks surge while international stocks lag. Other years, the pattern reverses. Over time, these movements cause your portfolio to drift away from your target allocation. Suppose you started with 70% stocks and 30% bonds, but after a strong bull run, your portfolio is now 80% stocks. You're taking more risk than intended. Rebalancing means selling some stocks and buying bonds to return to your 70-30 target. This enforces a disciplined buy low, sell high approach. For most investors, rebalancing once or twice per year is sufficient. Asset allocation ETFs have revolutionized DIY investing in Canada. These are complete, globally diversified portfolios in a single purchase. Here's how they work. An asset allocation ETF is a fund that holds other ETFs. A growth-oriented product might hold ETFs tracking Canadian stocks, US stocks, international developed markets, emerging markets, and various bond markets. The provider handles all rebalancing, maintaining your target allocation automatically. Major Canadian options include Vanguard VCNS 4060, VBAL 6040, VGRO 8020, VEQ2 100% equity. iShares XCNS 4060, XBAL 6040, XGRO 8020, XEquity 100% equity. All in, fees typically range from 0.2% to 0.25%, dramatically lower than traditional mutual funds. The most critical decision is selecting an appropriate equity to fixed income ratio. Consider these factors. Time horizon. Money you won't need for 20 to 30 years can weather short-term volatility. Money needed within 5 years should be primarily in bonds or cash. Risk tolerance. Be honest about your emotional response to losses. Could you watch your portfolio drop 30% without panic selling? If not, a more conservative allocation is appropriate. Risk capacity. This is your financial ability to absorb losses. Someone with a pension and substantial savings has high risk capacity. Someone living paycheck to paycheck has low risk capacity, regardless of time horizon. Here are some general guidelines. Ages 20 to 40 with stable income, 80 to 100% equities. Ages 40 to 55 with good savings, 70 to 80% equities. Ages 55 to 70 approaching retirement, 50 to 70% equities. Retirees 70 plus, 60 to 40% equities. These are rough guidelines only. Your personal circumstances may warrant higher or lower equity exposure. Let me give you a practical step-by-step plan to get started. Step 1. Establish emergency reserves. Build 3 to 6 months of essential expenses in a high-interest savings account. This prevents you from needing to sell investments during emergencies. Step 2. Eliminate high-interest debt. Pay off credit cards and payday loans before investing. The guaranteed return from eliminating 20% interest debt exceeds any reasonable investment expectation. Step 3. Open appropriate accounts. Open a discount brokerage account. Questrade, National Bank Direct, TD Direct, Wealthsimple. Set up TFSAs first, then RRSPs as appropriate. Step 4. Select your asset allocation ETF. Choose a product matching your target equity/fixed income ratio. If unsure, start conservatively. You can always become more aggressive later. Step 5. Automate contributions. Set up automatic transfers from your checking account to your investment accounts. Schedule them to coincide with your paycheck. Start with whatever you can afford. $100 per paycheck is better than nothing. Step 6. Stay the course. Continue contributing through markets ups and downs. Resist the urge to check your portfolio daily. Review annually. Now, the strategy is simple, but that doesn't mean it's easy. Investment success depends less on brilliant strategy selection and more on consistent execution. The biggest enemy of investment returns isn't poor fund choice, it's behavioral mistakes. Research from firms like Morningstar consistently show that investors earn lower returns than the funds they invest in. How is this possible? The answer is poor timing, buying after strong performance and selling after declines. Imagine two investors who both own the same index fund over 20 years. Investor A invests $500 monthly, like clockwork, never checking the balance, never making changes. She earns the fund's full return of 8% annually. Investor B also invests $500 monthly, but watches his portfolio constantly. During the 2008 crash, he panics and sells everything. He waits until 2010 when markets have recovered to start again. During COVID, he reduces contribution. His actual return is only 5% annually, despite owning the exact same funds. After 20 years, Investor A has approximately $294,000. Investor B has only $206,000. That's 30% less wealth from the exact same fund due to solely behavioral mistakes. Let me walk you through common psychological traps. Loss aversion. We humans feel the pain of losses roughly twice as strongly as the pleasure of equivalent gains. This makes watching your portfolio decline emotionally excruciating, even when it's temporary. The solution: use an allocation conservative enough that declines won't trigger panic sales. Consider viewing your portfolio less frequently during volatile periods. Recency bias. We tend to believe recent trends will continue indefinitely. After years of strong returns, investors become euphoric and increase risk. After crashes, we become pessimistic and flee to safety. The solution? Maintain a consistent strategy, regardless of recent performance. Overconfidence. After a few successful trades, many people believe they have special insight. This leads to excessive trading and concentrated positions. The solution? Remember that if beating the market were easy, professional managers wouldn't struggle so consistently to do it. Analysis paralysis. Some investors research endlessly, trying to find the perfect strategy or the perfect time to invest. Meanwhile, their cash loses purchasing power to inflation. The solution? Perfect is the enemy of good. Choose a reasonable strategy and start. Time in the market beats time in the market. Here's how to build investor discipline. 1. Automate everything possible. Automatic contributions removes emotions from the equation. You can't panic if you're not manually deciding each month whether to invest. 2. Limit portfolio monitoring. Checking your portfolio daily serves no useful purpose and increases the likelihood of emotional decisions. Quarterly or semi-annual reviews are sufficient. 3. Ignore financial media. Financial news exists to generate engagement, not to provide useful investment guidance. Headlines are designed to provoke fear or greed, not to help you make sound decisions. 4. Write down your investment plan. Document your target allocation, contribution schedule, and rebalancing rules. During stressful periods, refer back to this plan. 5. Think in decades, not days. Your investment timeline is probably 20, 30, or 40 plus years. What happens this month, even this year, is largely irrelevant to your long-term outcomes. Successful investing isn't mysterious or complicated. It comes down to a few fundamental principles applied consistently over time. Start as early as possible to harness the power of compound growth. Save consistently even when it's difficult. Invest in globally diversified low-cost index funds. Choose an asset allocation you can maintain through volatility. Ignore market predictions and financial media noise. Stay the course during inevitable downturns. The investment industry profits from complexity and frequent trading. They want you to believe that successful investing requires constant attention, sophisticated strategies, and expensive professional management. The evidence overwhelmingly suggests otherwise. The simple strategies I've outlined today: buy globally diversified index funds, contribute regularly, and maintain discipline, have worked for millions of investors and continue working today. They'll likely work for you too, provided you apply them consistently. Whether you're 25 or 55, single or married, earning $40,000 or $140,000, these principles apply. The specifics may vary: your contribution amount, your asset allocation, your timeline, but the foundation remains the same. Take the first step today. Open an account, make your first contribution, set up automatic transfers. The journey to financial independence begins with that first decision to start. Your future self will thank you for the discipline you demonstrate today. If you found this helpful, I've got more videos on Canadian retirement planning, tax strategies, and wealth building. I'll see you in the next video.